Welcome to the Kapital News. I am your host, Alex Karitis. Today is Friday, March 26, 2021. Thank you so much for joining me. The title of today's podcast, Jobless Claims Remain Above GFC, the Great Financial Crisis. I was off yesterday, so we're going to do our typical Thursday data dive. And obviously, we're going to focus on jobless claims, Federal Reserve's balance sheet, and finally got that monthly update with respect to M1 and M2 money stocks. So we'll get to those monetary measures here momentarily. Also want to discuss briefly almost the certainty that we will be seeing higher taxes if you aren't already seeing them now, depending on your locality, your county, your city, your state, what have you. But they're likely coming from the federal government as well. Highly predictable. I have been saying this, I think, since 2019. Because of the deficits that we were running before COVID-19. Yes, I am all for tax cuts. I want to abolish the Federal Reserve. I want to abolish the federal income tax. But if you're going to cut taxes, you have to cut spending as well. And nobody in Washington ever seems to want to do this. Whether it's the most progressive of Democrats or the most, quote-unquote, conservative and fiscally conservative of Republicans. Nobody wants to cut any spending. That is a huge problem. If you cut taxes, you have to cut spending. All you're doing is solving half the equation. And if you get a 50% on a math test, that's a big fat F. And that's what we continue to witness. But that type of economic theory, for whatever it is, for whatever reason, more of a hypothesis, and really at this point it's lunacy because it doesn't work. But for some reason, the Republicans and conservatives and radio talk show hosts love to push that narrative of cutting taxes, but they never say anything about really cutting spending. You have to do both. And I really wish the conservatives would come out more strongly against taxes altogether and say, let's get rid of the federal income tax. Let's institute a consumption tax. And that's what it should be. And we can get to that in another podcast. I might do a write-up on that too, sort of just how I see, we'll call it the Karitis plan, for lack of a better term. Might just put that on thecapitalnews.com for everybody to check out in the not-too-distant future. But that is just some basic economics, I think. The taxes are going up, of course. They don't want to cut any spending. Treasury Secretary Dingbat Yellen is pushing for higher taxes as well. She doesn't know what cutting spending means. And, of course, they're not going to do it because their precious GDP figure will, of course, take a hit. Now, it would be for the better in the long run, but these people do not care about the long run. They care about political expediency. They care about the next quarter, not the next quarter century. That has been problematic, and it is proving to be extremely problematic because all we have done was brought forward a ton of future prosperity and growth just so we could make things look better today. That has to stop. We might be at a point where it's too late. I am still somewhat optimistic that we haven't yet necessarily crossed that threshold, but we are damn close to the point of no return. And with $1.9 trillion in spending, another $3 trillion being proposed, and I can almost guarantee you it's going to pass. Not necessarily in one big swoop, but piecemeal. They will end up spending close to another $3 trillion before it's all said and done. And part of the tax increase that might come on top of that, according to Pete Buttigieg, now our transportation secretary, well, there might be a mileage tax. So they're going to try to, I don't know what you want to say, kill two birds with one stone, try to tackle climate change, so maybe that gets less people off the road, not driving as much. And it's still another way to increase tax revenue. They're going to come up with many, many different ways to raise as much money as possible because you cannot keep doing what they are doing. And if you are going to continue to do what they are doing, then just get rid of taxes altogether and just say we're just going to print all the money. And of course, those need to be some conversations that we need to have as a country. And those are questions that need to be asked of Joe Biden. He wouldn't know what any of that means, but it needs to be asked of him. Kamala Harris would just start laughing hysterically because she doesn't know what the hell she's doing either. Janet Yellen wouldn't answer the question. Jay Powell won't answer the question, but the question needs to be asked. If you're going to run several trillion-dollar deficits for the past couple of years, and it seems if they can do it next year, they're going to get away with it next year too. If you can do that, if you can basically exceed tax revenues, you double them. So we're bringing in 3.5, we're spending 7-8 trillion. Then obviously the taxes that we are bringing in is not a constraint to the size of the budget deficit. So then why pay taxes? Just have the Fed print all the money and call it a day. I would like to see them answer that question. But that question is not asked. It needs to be, and it needs to be answered. And then, of course, we talked about the Suez Canal fiasco, that traffic jam that took place earlier this week. Unfortunately, that's still the case. Some estimates are up to about $400 million an hour. This is costing the global economy $400 million per hour, staggering figures. But it's really no surprise when you look at it, when they tell us 10 to 12% of all global trade goes through the Suez Canal. And they continue to chalk it up to the wind, a sandstorm in the wind. I'm skeptical of that. I mean, I'm sure it could have had something to do with it. Again, I'm no captain of these ships, don't claim to be an expert, but that just seems a little suspect to me. And of course, the longer this drags out, the worse it will be. We have enough supply constraints and disruptions as it is due to the pandemic, and this is not making things any better. Market performance, we have the dollar index at 92.73 going into the weekend, 92.73, continuing to rise. Again, remains at levels we have not seen since last November. Everything is just going up today. Bitcoin is at $55,000 a coin. And despite the dollar gain today, you also saw some of those cross-currency pairs gain as well, with the dollar actually weakening. So the euro gained, the British pound gained, the Aussie gained, the New Zealand Kiwi gained. Almost everything against the dollar was up, and the dollar index as well. That's not something you typically see. On the stock price, on the stock market front, we have the Dow Jones putting on a gain of 1.4%. The S&P putting on a gain of 1.6%, and the NASDAQ 100 putting on a gain of 1.5%. So despite the fact that we have an increasing dollar, did not put a dent into equities today as they all rallied. The Japanese cash trade put on a gain of 1.6%, and a green board across the pond in Europe, all up 1% or higher. And the Australian markets put on a gain of 0.5%. On the share price front, Apple put on a gain of 0.5%. Tesla was actually a loser for the day, giving back 3.4% to trade at $618 a share. Microsoft put on a gain of 1.7%. Amazon about 0.2%, and Facebook put on a gain of about 1.5%. One of the big gainers of the day with the big blue chip stock was Intel, putting on a gain of 4.6%. On the commodity front, I guess they can chalk this up to whatever they want, the weather, the Suez Canal disruptions, but oil put on a solid gain, 3.6, almost 4%. WTI is now trading at $60.72, Brent at $64.36, natural gas $2.56. Gold and silver hung on today. Gold $1,732 an ounce, silver $25.05, and copper hanging in there as well at $4.08 a pound. And Uncle Sam's 10-year junk note is yielding 1.67%, also an increase on the yield for the day. So the narrative has been, as of late, an increasing dollar and increasing yields on the bond market, especially with the 10-year Treasury note, has been putting downward pressure on stocks. However, that was not the case today. The dollar index caught a nice bid, and so did Uncle Sam's 10-year junk note, up to 1.67%. Of course, that means there is a selling of the 10-year, but nonetheless, there is, at least going into the weekend, a breakdown of that narrative that we have been talking about here, that the financial mainstream media has been pushing for the last several weeks. So obviously next week will be a completely different week. Who knows what will happen over the weekend, but at least that is the story going into the weekend. Now on to initial jobless claims. So the number coming in at 684,000 for the prior week ending March 20th. But as the title of today's podcast states, this is still higher than where we were during the depths of the great financial crisis, which was about 665,000. So as I've been stating here repeatedly for the past several weeks, I will not say that jobless claims are down until we are at least at those levels we were at during the depths of the great financial crisis. Just to put all of this into context, because I think that is missing almost on a weekly basis when these numbers come out, because not too many pundits or analysts, at least not that I ever hear or see or read about on social media or anywhere else, bring up this point. I like to bring this point up every single week because you have to understand how devastating and destructive these lockdowns and restrictions have been. The great financial crisis was the worst financial and economic episode we have experienced since the Great Depression. And 665,000 was the worst initial jobless claims figure that we saw. Now, it stayed in the 600s for a few months, and then it went down. We were hoping to see that take place here, but it's been a year. And we continue to see these numbers around 700,000. Last week's number was revised upward, unfortunately, by 11,000 to now stand at 770,000 for the prior week. So let's take a look. So again, for the week ending March 20th on the seasonally adjusted initial claims, 684,000. Non-seasonally adjusted comes in at 657,000. For the week ending March 13th, for continuing jobless claims on a seasonally adjusted basis, we're at 3.8 million. That's a week-over-week decrease of 264,000. On a non-seasonally adjusted basis, it's at 4.2 million, a week-over-week decline of 278,000. For the week ending March 20th for the Pandemic Unemployment Assistance Program, 242,000, a week-over-week decrease of 42,500. For all programs in aggregate, regular state, federal employees, newly discharged veterans, the PUA and PEUC programs, extended benefits, state additional benefits, and a work-share program gives us a grand total of 18.9 million. This will be for the week ending March 6th. Recall that the aggregate number lags by a couple of weeks. So 18.9 million is the figure. That is a week-over-week increase of some 734,000. So that continues to be a volatile series, as we have been noting for the past several weeks. It goes up a million, down a million, up 2 million, down 2 million, up 800, down 700. All this volatility in this number. And of course, I attribute a lot of this to the distortionary effects that the federal government continues to throw into the system. But nonetheless, that is still a staggering and heartbreaking number. 1 year into these lockdowns and restrictions, 18.9 million gives us a de facto unemployment rate of 13.3%, which is double, more than double, the official unemployment rate of 6.2%. And of course, again, as a reminder, the Federal Reserve is even challenging the Bureau of Labor Statistics' official unemployment number, saying, no, it's not 6.2%, it's actually closer to 10%. And we know it's north of 10%, but it has to fit their narrative. They want to justify further fiscal and monetary action. In order for them to do that, the narrative has to be such that there is more destruction and more devastation out there in the real economy than even what the official government statistics say. And that is news, ladies and gentlemen, because the Federal Reserve just simply does not do this. Now, it'll be interesting to see if they ever challenge the same Bureau of Labor Statistics, which also calculates the inflation figures, if they will ever challenge the CPI, the Consumer Price Index. They're just going to nitpick. They're just going to, I should say, cherry pick what they want, whichever suits their narrative. Unemployment is worse than the official numbers? Okay, Congress, you have to do more. We want to do more, but it really has to come from you. But we will be there to finance it. So get your butts in motion and do something. Oh, they did. They did. $1.9 trillion out of nowhere. And they're coming for another $3 trillion. Cannot make this stuff up. but that is what they are going to do. Now, the inflation figures, well, what do you think they're going to say? If the CPI is low, if it's below what the Federal Reserve is attempting to target, 2%, then they'll believe it, because they'll say, well, look, we're still not hitting our target, which everybody who has a brain and a couple brain cells to rub together knows what's going on in the real economy, knows what's going on with prices, especially of the goods and services that you need, not just what you want, again, with a focus and an emphasis on what you need. Those prices have been going up and they will continue to go up for the foreseeable future. But the narrative, of course, will be for the Federal Reserve's benefit. Well, there's still not really strong inflation, so we can continue to prime the pump. That is their goal. That is what they want to do. This is a massive wealth transfer. End of story. That's what it is. They are showing you in our faces every day who they work for, and it is not the American people. Not even close. They don't take any responsibility for the wealth and income inequality that exists in this country. We talked about those numbers earlier this week, staggering as to how much wealth is held within the top 1% and the top 10% compared to the bottom 50th percent. This is not a recipe for success. It's a recipe for disaster. It's a recipe for political, economic, and social decay, maybe even ruin. I hope that's not the case here in this country, but it might be. If we continue on this path, it is most definitely not going to end well. People need to wake up. But as long as people continue to get their sit down and shut up money, well, guess what? That's exactly what they're going to do. They're going to sit down and they're going to shut up and they're going to let these people run away with the trillions and trillions and trillions that they are creating out of thin air. And talking about monetary measures and out of thin air, the Federal Reserve's balance sheet now stands at $7.7 trillion. This is now at an all-time high, which we have been expecting. The Federal Reserve remains committed to purchasing $120 billion worth of Uncle Sam's debt and mortgage-backed securities, so some combination thereof. Of course, it'll be to their liking, whatever they think is needed. But again, $7.7 trillion, a little bit above that. So we anticipate continuation of all-time highs on a near-weekly basis, and we project, of course, that if the Fed does remain committed to its $120 billion per month policy, when we see no reason why they're going to deviate, if anything, they will add to it, that we will have a Federal Reserve balance sheet of $8.5 trillion, probably north of that. I am still anticipating by the end of the year it'll be closer to $10 trillion, maybe even slightly above it. So that is just quite staggering. And again, for a little context, a little perspective, going back to the great financial crisis, the Federal Reserve's balance sheet was a little north of $800 billion. Okay? So we are no longer in the world of billions. We are in the world of trillions. People gasped when they were throwing around $700 billion for TARP, the Troubled Asset Relief Program, which was supposedly going to be part of the saving grace for the great financial crisis, of course, that major bailout. That was $700 billion. That's chump change compared to what we were throwing around today. Think about that. It was only 12, 13 years ago. So the Federal Reserve's balance sheet has expanded tenfold over that period of time. It's quite remarkable. It took them from 1914 to the great financial crisis to get to $800 billion. And in a short 12 to 13 years, they've expanded it tenfold. What's that saying about how you go bankrupt? Very slowly and then all at once. This is a banana republic, ladies and gentlemen. The charts and graphs are there. You can find them at the Federal Reserve Economic Data website. You can find them on the capitalnews.com on our recent monetary measure presentations. Check them out if you haven't. These graphs are criminal, and you do not need to be a market analyst, an economist, a mathematician to understand this. This is lunacy. And all of the problems that I talk about, that is what it looks like. That is what it looks like. M1 money stock has finally been updated. This stands at $18,411 billion. $18,411 billion, again, an all-time high with respect to M1 money stock. And of course, they changed the definition of M1 money stock to include additional savings and money market funds, which is why we see this huge uptick. Because I believe in monetary measures presentations that we did, it was around $7 trillion. So you can just see how big of a difference that was due to the recalculation. M2 money stock also updated. Now sits at 19 trillion, 670 billion. All-time high, of course, on all three of these monetary measures, and we anticipate this will continue throughout the remainder of this year. So not only will these monetary measures continue to go up, our national debt will continue to go up, our deficits will continue to go up, and our taxes are very likely going to increase as well. It's just basic math. At some point, you're going to have to raise taxes to pay for all of this crap. That's what you're just going to have to do, because nobody wants to stand up and say, well, we're going to cut Social Security. Nobody wants to do it. Nobody wants to step up to the plate and say we're going to cut Medicare and Medicaid. Nobody wants to do it. Nobody wants to step up to the plate and say we got to cut back on the Defense Department. Not going to happen. Not going to happen. Those are the three biggest outlays. And of course, the Federal Reserve is fighting like hell to keep interest rates as low as possible, because another major outlay is the net interest that we pay as a country. And you can imagine, with $28 trillion in debt and rising, because just wait till they get through with this $3 trillion garbage, okay? The slightest of increases to our borrowing costs makes a big difference. Makes a big difference. And that's why I talk and I push for this audience to understand the power of compounding interest and how it can work for us, or unfortunately, how it can work against us, and that is what we are witnessing. So the day of reckoning, of course, is going to be when the markets say enough is enough. We're not buying into this nonsense anymore. I was hopeful that that day would have come already. It's going to be painful. It would have been painful even when I thought it should have happened. But I'm a small fish in a huge pond. Okay, and what I think ultimately doesn't matter. People continue to buy in to what the Federal Reserve is saying, I think, and other central banks for that matter. And of course, this is buying time when you throw trillions and trillions of dollars into the system. But if it was that simple, then, and it was that effective, then why do we ever stop doing it? What's the reasoning to stop sending out sit down and shut up money checks? Why should that gravy train ever stop? In fact, shouldn't it be even more? What's the limit? What's the constraint? What's that number? Ballpark it. Ask that of Janet Yellen. Ask that of Jay Powell. Ask that of the hyena, Kamala Harris. Ask that of the demented joker, our President of the United States, Joe Biden. They're not going to answer you. The White House isn't even going to know what the hell you're talking about. Janet Yellen will, but she won't answer it. Jay Powell will, but he won't answer it. Politicians aren't going to push these types of questions because they love it. Because they don't want to cut spending either. Most of them don't want to go back to their districts or their states and tell their constituents, yeah, your taxes are going up. The Democrats will do it because they make it about class warfare. So they attempt to single out the rich or the wealthy. Even though we know perfectly well, and we did this exercise several times throughout last year, looking at the usdebtclock.org, and just saying, let's look at where we went into the weekend, so on a Friday, and let's see how much debt was accumulated over the weekend when we do our podcast on the following Monday. And for several weeks throughout last year, you are talking increases that would have been the entire net worth of some of the wealthiest individuals on the planet. And you think you can just increase their taxes and you're going to pay for this stuff? Come on, this is insulting. It is insulting. So for Pocahontas and Elizabeth Warren to say, well, we're just going to tax them at 2 cents, 2%, and of course she tries to say just 2 pennies, because doesn't it sound like nothing? But it's 2%. Doesn't add up. Doesn't add up. You could have confiscated 100% of Jeff Bezos' net worth, and all you would have done was finance the government for a weekend. you could have confiscated Warren Buffett's entire net worth. He's like 90 years old. Took him his entire lifetime to accumulate that wealth. You could have confiscated 100% of it. It would have financed the government for a weekend. So, look, we're in a lot of trouble. Nobody wants to be accountable. Nobody wants to take any responsibility. They want to continue to kick the can down the road. We have these types of, quote unquote, stellar returns in the equity markets. Well, that just usually typically means looking forward over the horizon. Those types of returns are usually not as stellar. And people are starting to look and do some studies, obviously, on the millennials in Generation Z. And they know what's going to happen to these younger generations. They are not going to have much of a economic or financial future. The strength of their 401ks is going to be weak at best. And again, this is perfectly predictable once you understand what debt is. We are stealing all of that future growth and prosperity. That future growth and prosperity belongs with the millennials in Generation Z and et cetera, down the line. We're taking it from them so that we can fill a void today. That's all it is. It's not fundamental growth. Yet GDP will go up because it's just an arithmetic equation. Government spending and consumption, major components of it. There's no great economic engine that is revving right now in this country. We have record trade deficits. So at least you maybe could have made the argument, well, look, we're giving all of this sit down and shut up money, but our deficits are going down. Our tax deficit's going down. Our trade deficit is going down, but that's not the case in either direction. So we have nothing to show for it. But what we are doing, obviously, is importing the production of other countries. So we're making them wealthier, and we're buying a bunch of crap that we probably don't need at the end of the day. A country's economic strength comes from production. The benefits of that production shows up in the spending. That's how it's supposed to work. We have fooled ourselves and peddle the argument that no, it's the other way around. That spending drives the economy. It's not how it works. And everybody is I think, starting to wake up to that. No, not a lot of the pundits, not the mainstream media, not the financial mainstream media. They're not going to cop to that. They have a narrative to weave. They have stories to tell. No matter if their stories collapse, they continue to push them. Which is why, again, I want to stress that everything went up. The dollar index, Uncle Sam's 10-year yield, stocks. That's not supposed to happen, at least not according to their narrative. That's not supposed to happen, but it did. Furthermore, we have an increase in COVID-19 cases around the globe, even though we have these miraculous vaccines and so many millions and millions of people are getting them. Cases are going up. Now, unless the market wants to continue on that narrative of bad news being good news or bad news being great news, okay, well then maybe that makes sense as to why stocks went up. Your guess is as good as mine, ladies and gentlemen. It's all make-believe. It's all, at the end of the day, money print. Don't ever lose sight of that. I won't let you lose sight of it. And of course, with those all-time highs, now it makes sense why stocks might be getting a boost because they continue to buy into it. But once they don't, I think it's look out below. Enjoy your weekend. I will catch you here next week. Stay diversified, stay vigilant, and stay with the Kapital News. I am Alex Karitis. Godspeed.